The market in May started to see a few changes, primarily due to the interest rates that have been rising due to the Fed trying to curb inflation. And the interest rate lever is a tool that the Fed has at its disposal. Now today, we're going to look at why the real estate market is not in a bubble and what lies ahead for the rest of the year. And we'll also look at home affordability as well as check as to how the prices are increasing. And finally, we'll look at what is happening nationally and how our local market is impacted. Now, are you ready? Let's go. Hey, Ravi, your local realtor with the Rams Group at eXp Realty. If this is the first time we're connecting, I welcome you to my channel and thank you for stopping by. I hope to provide meaningful, relevant, and educational content to help you be in the real estate know. Now, let's start by answering the first question. Are we in a bubble? Is the market going to crash? Well, the good news is that experts think that we're not. And what is happening today is drastically different than what happened in 2008. Now, let's quickly look at the home values since World War II. Now, why from the World War II, you may ask? That was when the start of the modern day housing boom happened in this country. And ever since then, up until today, there's been one time in this country where homes lost significant value, and that was back in 2008. Now let that sink in. So back in 2008, we saw homes lose value really for two reasons. Number one is loose lending standards. Now back then, no income verification, no job verification, and we know how that ended up, right? And number two was the cash out refinances, and that was huge. Now people took the equity they had built in their homes, cash it out, bought jet skis, cars, went out on vacation, the financed lifestyle, if you will. Now, they did things thinking that it was never going to end, and it ended poorly. Now, to recap, applying for a loan that you did not qualify for, and then you take out the equity, and then cash it out, and that's what ended up in 2008, where homes continued to lose value. Now, the other question that plays into the crash question is everything coming out of the past 2 years from COVID. There's one thing that we have to recall. Forbearance, remember? The tool that gives those who need help weather the storm and their housing payments. Well, the great news is the forbearance numbers are edging downward. As of the most recent numbers in April of this year, there were a total of 690,000 loans that are still in forbearance, which is well below where we started out in May of 2020. Now, looking at forbearance, 82% have come out of it. 37% in the green area were paid in full. 44.6%, the blue shaded area, went through some kind of workout with their bank, their lender, either a modification of rate or a deferral even. Also, 4 out of 5 people either went through a modification or paid it off in full, and there were no issues. This is a super positive sign, right? Now, talking about the market crash, the market isn't going to crash as people have options today that they did not have before. Now, if you have been negatively affected by the pandemic, you can sell your home with the appreciation that you would have seen over the last couple of years even, right? Take care of the home selling expenses like paying real estate commissions, excise tax, or what have you. Put some money in your pocket and get to the other side of crisis. Yes, that is a solution. So understanding why the housing crisis back in 2008 happened and then understanding the current piece of forbearance is critically important. Now let us delve a little bit more into what happened in 2008. Loose lending standards drove the housing crisis then. Well, the bottom line is lending standards are nothing like what they used to be back in the 2000s even. We talked about the things that people had done to cause the crisis. Well, there's two components that this report by Urban Institute outlined. First, it produces risk in the mortgage business, and second is the borrower risk. Now, the red area there, which is the product risk, now think of it as the types of loans that were available to people. And that's been virtually eliminated, right? If you start back on the left side of this graph in 1999, we're talking about all the way to 2021. Now you see the red portion, it's gone completely. It's not there at all. The loans that were available back then are not available today. Now the brown portion there, or the borrower risk, now think about that as an asset profile, credit score, and all the things that it takes to qualify for a loan. And those have been severely curtailed. it's gotten harder to qualify for a loan after the housing crisis, which is good, right? Moving on, let's look at what's ahead for 2022. We are here in May. The Fed started off the month by raising Fed funds rate. Our contacts are asking us, hey, with the rate hikes, are we heading for a recession or what have you? Now, home prices are going up, right? Interest rates are going up as well. So a lot of questions about what's ahead lingers in people's minds. Now, many people are asking if the homes are going to lose value later this year. Now, certainly not. That's what the experts are saying for this year. Now, if you see, they start to fall between 8 and 10%. And we are seeing that these forecasters had a bias towards the upside, meaning that they're raising their forecasts. And we're certainly seeing that today. Right? As you know, the interest rates have been slowly inching up and the forecasters, whatever they're saying is coming to be true. Now, while this is all national news, about 8 to 10%, King, Snohomish and Pierce counties have been seeing between 15 and 28% appreciation year over year to this point. And we have been pulling the curve upward with respect to prices, right? And we'll certainly continue that trend going through the rest of this year. Then moving on, let's talk about home affordability, which is another hot topic. With home prices rising, the interest rates rising, it really makes people have questions about affordability. And a closely tied component is inflation, which is how much people are paying for essentials. Now, this is interesting. More than 70% of respondents say that they're feeling the effects of inflation, right? This is mostly gas prices and groceries even, when you just walk into the grocery store. And we can all relate to this as well, which is felt at the gas pump. Prices are rising all around and it's impacting what we can spend on a day-to-day basis, right? That's what it boils down to. Now let's look at closely at how affordability is impacted with rising interest rates. Now the chart here talks about a $300,000 principal and interest only payment. While this data is national, locally we'll have to multiply this by 3 or 4 as the prices around Seattle are just about there, like between 1 and 1.2 million. However, this will provide an idea on the increase in monthly payments. Now, if you look at January of 2021, the mortgage rates were at historic lows, right? A typical mortgage payment on a $300,000 home was about, say, $1,200 a month. Fast forwarded to where we are today, this rising mortgage rate environment makes things different. If we think about where mortgage rates are projected to go, let's say the mortgage rates later this year are around even 5.5%. That mortgage payment jumps to over $1,700. So if you're talking about $1,200 to $1,700, that is roughly a $500 difference nationally. Now locally, this would mean about a $2,000 monthly payment increase, right? Now that's putting a lot of concerns in people's minds as they're thinking about it. And it's not only going to cost more for us to buy a home, but all other aspects for us to conduct our day-to-day life going up, it's kind of acting in a negative way. So yes, while inflation is a concern, the rising mortgage rates are even more concerning. And we were at 3.1% by January 1st of this year, and it is May, and we are around 5.25 percentage points now. However, the affordability equation will be even more a question as the rates steadily inch towards 6% and beyond. Now, with interest rates rising, the next logical question is going to be how is this going to impact sales, correct? Now, rising mortgage rates, we know, is going to impact slightly. People are going to make a decision regardless, right? They're either going to jump in and say they'll go ahead and purchase, hey, I want to get ahead of the curve or what have you. And the rising rates and the rising prices are going to be of little significance considering where we're headed. Or they're going to say, this isn't for me. It's going to cause people to make a decision either way. That's what I'm trying to get at. But the overall takeaway is that the buyer demand is still strong, and this will not impact the overall demand that we are seeing right now. So many buyers in the market and so few homes for sale, right? The buyer demand is very, very real. So yes, it will put a pressure on that lower price point buyer, but that overall demand is still really, really strong. So if you are a first-time home buyer or an investor and thinking about rising rates and prices, I'd like to ask you to think about the home purchase as a long-term investment, which is going to matter to your financial future, right? And think about it that way. Now, after looking at why we're not in a bubble, what lies ahead for the rest of the year, and discussing affordability, let's now turn our focus to what is happening locally in the King, Snohomish, and Pierce counties, shall we? Now, the number of new homes that came on the market in King County decreased by 5% year over year, which means King County housing market is still hot as lower supply is causing a higher demand. Now let's look at Snohomish County on the other hand. More homes came on the market year over year, causing an increased supply. Now, when the market starts turning, right, when it just turns to becoming a buyer's market from being a seller's market, the north and south areas will start getting impacted first before it moves towards the core of King County, like Seattle, Eastside, etc. Now, next, let's turn our focus to pending sales. In King County, pending sales decreased, which means that the new listings that are coming are kind of sitting a little longer on the market. Now, the demand is still strong, so no cause for concern there yet. However, in Snohomish and Pierce counties, the pending sales increased compared to the last year, to mean that homes are being absorbed by the market more quickly than King County. Now, what is absorption rate, right? The term absorption rate, if you will, refers to a metric used in real estate market to evaluate the rate at which the available homes are being sold in a specific market during a specific time period. Now, it's calculated by dividing the number of homes sold in any time period divided by the total number of homes that are available for sale. Now, looking at the days before which homes go under contract, King County rang in at about 7 days, which means that homes were going under contract sooner compared to the same time last year. Now, in March, it was 9 days, and this has gotten even lower. So given that it is spring, and given that there is talk about buyers taking a breather due to the interest rate situation and other uncertainties surrounding, homes going under contract in King County is not showing a slowdown at all. Now let's look at the median and average home prices. Now this data shows that both these metrics have been the highest that they've ever been across all three counties, King, Snohomish, and Pierce. Now, we like the median metric much more than the average because the median is at the dead center, wherein 50% of the homes are above and 50% of the homes are below. An average home in King County sells for a whopping $1 million. Oh, wow. Who would have thought, right? That's how crazy the market is. Now, looking at the price escalations, which is how high the homes went over ask, King County rings in at about 112% year over year, which is the average across the entire county, north to south, east to west. Now, the price escalations with buyers waiting on the sidelines may ebb. Now, I am keeping an eye and I will let you know. So if you are a seller, leverage the market while it's still hot. And there are still buyers out there who badly missed out on homes and are ready to get into homes, if you will. And if you're a buyer, on the other hand, yes, rates are higher than they were. However, with the way the rates are rising, it would make little sense for you to pay 6 or even 7% if you waited. Now, with the pending rate hikes, interest rates will get there. So act quickly if you're a buyer. Well, that was a quick wrap. Now, I've included the data for all the three counties, King, Snohomish, and Pierce, below for you to slice and dice the data and get an overall perspective. And as always, I'm available to answer any questions you may have or help you drill down and find any statistics for hyper-local areas that you may be interested in. Let me know, okay? And I've also included my contact information below in the description as well for you to get in touch. Now, if you found this information useful, consider subscribing to my channel. And until next time, you and your family stay safe, and I will talk to you soon. Bye-bye.